This video is about forward and futures contracts. Financial derivative instruments are financial instruments that derive their value from the value of an underlying asset. A derivative instrument itself holds little value, and its entire value is dependent on the underlying asset. So financial derivative instruments are just contracts between two parties, and their value is derived from the underlying asset. And then the underlying asset, for example, if it's crude palm oil or it's Apple stock, the value of these contract, which you name them as financial derivative instruments, is derived from the value of crude palm oil or Apple stock in my examples. So in this subject, we will focus on forward, futures, and options. Let's start with forward contracts. So forward contract is a contract between two parties agreeing to carry out a transaction at a future date, but at a price determined today. Let me give you an example. Suppose there is a farmer that sells chicken. So the farmer has a farm and sells chicken. And on the other hand, we have some companies or some customers that buy chicken from the farmer. So we have producer of chicken on one side, and on the other hand, we have consumers of chicken or those who buy chicken. So what happens if in the future, in the next 3 months, the price of chicken increases? I think this means that the farmer can sell chicken at a higher price, so more profit for the chicken. So the farmer will be happy, right? But what happens if the price of chicken drops? In this case, this means that the farmer has to sell chicken at a lower price. And this means that it's a loss or maybe less profit for the farmer. On the other hand, if the price of chicken increases, the buyer, which in this example is KFC, if the price of chicken increases, this means KFC has to buy chicken at a higher price. And KFC doesn't like this, right? Because KFC does not change the price of its products, of its different types of sandwiches or chickens that he's selling. He cannot change them every day. So they need to know how much they can buy, and then they will compute all those operation costs, everything, marketing costs, everything, and then they determine the price and print on their menu. And usually they don't change it every day or every month, right? So KFC needs to make sure that the price of chicken won't change in the near future, right? So if the price of chicken increases, KFC usually cannot change the price of its products quickly. So this means that less profit for KFC, and this may impact on their future plans or maybe even loss for KFC. But if the price of chicken decreases, this is good for KFC because the price of their products is fixed. It's already in the menu, but they are buying the raw material, the main raw material for their products at a lower cost. So this means more profit for KFC. So what happens if the price of the chicken in my example, if the price of chicken increases or decreases, this can be good for the farmer and at the same time bad for KFC. Or if it's good for the farmer, it's bad for. If it's bad for farmer, it's good for KFC. If it's good for farmer, it's bad for KFC. So because they are the two sides of the contracts. But in some cases, people don't want to take this type of risk. They want to fix the price. They want to lock in the price. For example, the farmer wants to make sure that he can sell chicken, for example, at 10 ringgit per kilo in the next 3 months, right? So then the farmer can plan, and then maybe he can borrow from a bank and invest and maybe expand their farm or whatever they want to do. So they prefer less uncertainty, right? So It's the same case for KFC. KFC maybe wants to reduce the risk of price changes. So they prefer to lock in the price. They prefer to make sure that in the near future, for example, the next 3 months, the next 6 months, they need to make sure they can buy chicken, let's say, at 10 ringgit per kilo. So in this case, both parties want to reduce the risk of price changes. So what they can do, they can sit together and sign a contract. And in the contract, they mention that they will, for example, the farmer will sell and KFC will buy chicken at 10 ringgit per kilo when, let's say, 3 months later or 6 months later. So there are a few terms they need to state, they need to mention in the contract. One is the type of the asset. In my example, the asset was chicken. It can be rice, it can be oil, it can be crude palm oil, or it can be financial assets like, for example, stocks, bonds, or stock indexes. So it's a broad range of things, anything you can include actually. Exchange rates, right? Anything you can include in the contract. So one thing is what we are talking about. What's the asset? What's the underlying asset? Number two is at what price we want to trade this underlying asset in the future. Let's say in my example, 10 ringgit per kilo for chicken. Or maybe for Apple stock, we agree to, for example, if I'm the buyer, I buy. If you are the seller, you sell at $2,000 in the next 3 months, right? So we agree on the price. Then we agree on the time when. 3 months later, 6 months later. For example, we agree to complete this transaction on 1st of July 2021. Another one is the size. At what size? How many kilo? How many shares of Apple, right? So we need to also specify the size of the contract. For example, in the chicken example, let's say 1,000 kilo of chicken will be delivered to KFC on 1st of July 2021. So another point is where, the place. They may say the farmer will deliver it to KFC warehouse, or maybe KFC will take delivery from farmer's farm. So they need to specify this as well. So it's a very clear, detailed contract. They will agree on these terms, and then they will just go back to their normal operation. Then on 1st of July, in my example, which is the maturity date, they will complete the transaction. For example, the farmer will deliver 1,000 kilo of chicken to the warehouse of KFC, and then KFC will pay for 1,000 kilo of chicken at 10 ringgit per kilo. And this is forward contracts. For forward contracts, we need two parties. So they need to complete each other. This means that both parties are interested in the same asset and they want to reduce the risk of price changes. Reduce the risk of price changes. This is actually the main function of financial derivative instruments. We want to reduce the risk of price changes, risk of interest rate changes. Right? So we want to reduce the risk. And now what happens? Suppose that they already prepared the forward contracts, and then if later the price of chicken increases, this means that the farmer still has to sell chicken at 10 ringgit per kilo, but maybe in the market now it's 12 ringgit per kilo. So of course the farmer won't be happy because he has to sell chicken at the fixed price, the price that they agreed, but in the market price is higher. But KFC will be happy because they now still can buy it at 10 ringgit per kilo from the farmer, but in the market is 12 ringgit. So if the price now goes up, because they already signed the contract, they already signed a forward contract, prepared a forward contract, so KFC will be happy and the farmer won't be happy in terms of the price changes. But if the price goes down, still farmer can sell at 10 ringgit per kilo. So if the price dropped to 8 ringgit per kilo, farmer should be very happy because it would be a loss for the farmer, but now the farmer still can sell it at 10 ringgit per kilo. But KFC lost the opportunity of buying the chicken at a lower price. But actually, they are fine with it because they knew that the price may move in the way that they make more profit. But they didn't want more profit. They just wanted less uncertainty. They just wanted to make sure they can plan for the future, they can fix the price, they can lock in the price. So to reduce the risk, they may use forward contracts. So forward contracts are very flexible. Why flexible? Why I'm saying flexible? Because it's just between two parties. They sit together and they prepare all terms based on their preferences, right? So they can customize it as much as they want. Um, but there are some disadvantages. Number one is the main one is lack of liquidity. This means that it's very hard to find another party, another person who is interested in this contract. Why? Because when you prepare a contract based on two parties' preferences, it has been customized too much. So it's very difficult to find someone else who is interested exactly in all terms that you mentioned in the contract and then transfer the contract to the third party. For example, you agreed with KFC to sell chicken, 1,000 kilo of chicken at 10 ringgit per kilo on 1st of July, and you deliver it to KFC, let's say, warehouse. So who may be interested in uh, 1,000 kilo of chicken at 10 ringgit on 1st of July? The third party should be interested to receive 1,000 kilo of chicken on 1st of July, and the other party needs to take the delivery from KFC warehouse. So it's difficult to find someone else to sell the contract or to transfer the contract. So this means that very little liquidity, and it says it's very difficult to. You need to just wait until the maturity and exercise the contract. And um, another issue is unfair pricing. This means that because in my example, let's say, because KFC is very powerful and a farmer is maybe a small farm, has a small farm, and in this case, KFC has a strong negotiation power. So KFC can force farmer to accept the price, right? So the stronger party can dictate the price can or other terms, right? For example, KFC would say, hey, if you don't mind, there are so many farmers that I can buy chicken from. So if you want, these are the terms: unfair pricing or unfair in terms of other terms of the contract. And another one, subject to default risk, because this is just a contract between two parties. Let's say, for example, 3 months later, when or first on 1st of July, when the farmer needs to uh, deliver the chicken. Suppose they agreed on 110 ringgit per kilo. Then in the market, suddenly the price increases to 20 ringgit per kilo. Then the farmer would say, oh, why I should sell at 10 ringgit per kilo? I don't care about this contract anymore. And the farmer may go to the free market and sell them at 20 ringgit per kilo. So what KFC can do? Actually, just go to a court and sue the farmer, and it may take years, right? So there's a these contracts are subject to default risk. Or on the other hand, if, for example, let's say that chicken price dropped to 1 ringgit per kilo, then KFC would say, hey, why should I follow this contract and buy chicken from the farmer at 10 ringgit per kilo? I will go to the open market and I will go to the market and buy it at 1 ringgit per kilo. So I save a lot. So I don't care. I'm a small farmer. I have good lawyers. So, okay, I don't care about it. So this is the problem. This is another problem of forward contracts. So in the next video, I will tell you about futures contracts.